I'm Alex Underwood. I'm the Managing Director of Empire Energy. We are listed on the Australian Stock Exchange. We are an upstream oil and gas company focused on the emerging Betaloo Sub-basin in Australia's Northern Territory. This is a basin that is one of the largest shale gas accumulations on Earth, and we are one of the most active players involved in moving this basin from the exploration phase into production and ultimately into very large-scale production down the track involving LNG export to Asia.
Fantastic. Alex, lovely to have you on the show. First time we've met or spoken. It is large. Described as third largest shale gas deposit on the planet by the chairman of Dow Chemicals. So, and I want to get into how you commercialize that, how you extract that. But first, just give me a sense of who the team is. So what's your background and the team around you?
Yeah, so I come from an oil and gas investment banking background. I worked for Macquarie Bank for 10 years and then Commonwealth Bank of Australia for a couple of years. Empire is a company that I've been involved in for many, many years because it used to be one of my clients when I was at Macquarie. And under my leadership, we've shifted the focus of the company somewhat away from mature conventional producing assets in the United States to the Betaloo Basin here in Australia. We have a small but highly effective team. We've got a small management and technical team here in Sydney. We work very closely with Australia's largest oil and gas consultancy by the name of Engage Energy. And under that team, we've been able to really kick off some pretty awesome records. We've drilled the longest horizontals in the basin to date, the biggest frack jobs in Australian history, and we're rapidly driving towards the early commercialisation in a pilot project.
Okay, right. But I think it's fair to say shale's not really as well understood in Australia as it would be in the American market, where obviously it's been going a long time. So just want to start with the understanding the project. So when did you guys pick this up, and what have you done since?
Yeah, so it's actually quite an interesting story of how we ended up with this shale asset in Australia. Under former management, our company owned producing conventional gas assets in Pennsylvania, and by pure serendipity, just happened to be sitting over what's the Marcellus Shale, which is now about 30% of America's gas production. And the company under that leadership sold those assets for very substantial profits. And our former CEO thought, well, if there are shale basins in the US, there must be shale basins elsewhere. And so he teamed up with John Warburton, who now sits on our board, and identified the Betaloo and McArthur Basins. That was back in about 2011. We picked up a very large acreage holding, 14.5 million acres. And now under my leadership, I joined in 2018, we've really been invigorating the company's efforts to not only hold that acreage, but really de-risk it and now move into commercialisation.
Well, it's an interesting time, actually, because you think of what oil and gas sector has been through the past few years. Obviously, last year or so has been a little bit better, helped by supply chain issues around the world off the back of Russia-Ukraine situation. But it's been tough for small companies to take on, big regional plays. And how do you go about financing them? How much money's been spent on this thing to date?
It's a very good question. I mean, having previously been a financier of projects like this, I do understand how challenging financing these projects can be. Over the last 5 years under my leadership, we've probably invested somewhere in the order of $70 to $80 million. And, while that's a significant amount of capital for a company of our size, it's been really pleasing to have very strong support from our shareholders. If you look at our major shareholders, a lot of them are highly successful investors in unconventional, i.e. coal seam methane gas in Australia, and they recognise that potential for very significant value creation. Another thing I think that small companies can do that bigger companies cannot necessarily do is, you can actually be quite nimble with the way you allocate capital, and you can find ways to really, make the most of every dollar you invest. And, I think when you look at the amount of work we've achieved with that capital we've invested, we've actually gone quite a long way already.
Right, but so tell me what you have done, because I'm interested in what you inherited in terms of the data set. Larger land pack is great, but you could argue it's a liability in some ways. So what did you know, and then what did you have to find out and to be able to deliver a strategy, whatever that strategy may be.
Yeah, so when the company initially acquired these assets, the data set was incredibly sparse. There had been a lot of drilling for minerals across this part of the Northern Territory. As you can imagine, Australia's been heavily explored for minerals, but mineral exploration wells tend to be quite shallow. Back in the 1970s, there was drilling for conventional oil and gas in this area, and that was quite handy because that showed us that there were these prolific shale formations. Back in those days, shale was never targeted because it wasn't until the advent of horizontal drilling and fracking that gas could be commercially exploited from these shales. There was a relatively slow ramp up, but recently, in the last 2-3 years, there's been a lot of work done. So we've done a couple of seismic surveys. We drilled our first vertical well, Carpentaria-1, in 2019. That proved that these shales were coming through our tenement. And then since then, we've drilled another 2 horizontal wells, which we've fracked and which we're going through flow testing at the moment. So we're moving up that curve relatively quickly now.
Right, Ben, but to what end? What are you trying to do? Because, like I say, big projects can be a real drain on, in terms of dilution, in terms of having to go and find, create, get partners in or find creative ways to kind of fund these things. So have you got, you talk about being nimble. So how nimble do you need to be to kind of move this thing forward?
Yeah, so it's very well known by the industry that the Betaloo Basin contains an enormous volume of gas. And these shales are very laterally consistent across hundreds of kilometres. So the sort of the exploration phase is behind us now. We are very much in the appraisal phase. So, it's one thing to have lots of gas under the ground, but unless you can extract it commercially, then it's going to stay there, right? So what we and other players in the industry are doing in the Betaloo Basin now is not searching for gas, but rather drilling horizontal wells and then working out how to fracture stimulate these wells. So in the US, these learning curves have been created over lots of different shale basins. The Betaloo is really the first major shale basin in Australia that's going through this process. And essentially what we're doing is leveraging off a lot of learning that's occurred in the US over the last 20 years, but then trying to apply those learnings to a quite unique geology because these rocks are much, much older than the US shale basins. And so essentially it's a process of research and development to apply fracture stimulation techniques from the US into this basin and to look to achieve commercial flow rates. And that's really our core focus right now is what flow rates can we get from these wells and then how efficiently can we drill and fracture stimulate them to bring the costing down.
Right. Okay, so it's not a case of if, it's a case of when and how efficiently. So I mean, to that point, I keep coming back to how does this thing get funded? Because you can't keep going out and raising equity, because I know you guys management are big shareholders in this, but you don't. So you especially don't want to keep diluting yourself. So how does this opportunity get commercialized?
Yeah. So to date, we have been issuing equity to fund our operations, and as you pointed out, our board of directors own over 20% of the company. That is real cash that we've put into the company. It's not like a lot of other small companies that just get free options. We've put our own capital to work here. And I think that's really important because our incentive is to create value, but also to protect downside. Being a former oil and gas financier myself, I understand that evolution that you go through as a company. And ultimately, you want to move from issuing equity to fund your operations to realistically being able to seek project finance. What project financiers want to see is they want to see gas sales agreements and they want to see commercial flow rates, and then they want to see a really strong development plan in place and obviously all of the regulatory approvals. We are going through the process of ticking all of those boxes. And one thing that I'm quite excited about that we recently announced is that Macquarie Bank, my former employer, has provided us a small funding facility. It's only about $15 million at this stage. And that's to fund some environmental bonds. And also that's a further forwarding of capital that will be secured against future tax rebates that we're expecting later this year. But that facility was structured to be able to grow into a project finance facility. So this year for us is all about seeking to achieve commercial flow rates, signing gas sales agreements, and getting the regulatory approvals in place, particularly with Indigenous traditional owners. That's a very important stakeholder group in the Northern Territory. And then pulling together our front-end engineering and design to move towards a final investment decision on the pilot project, hopefully later this year.
Okay, so look, I'm trying to keep this conversation fairly high level. And if you guys come back on, we can kind of dig into the weeds a little bit. But with regards to the commercialization bit, I'm going to kind of skip past the technical thing. You're going through a process of working at the most efficient way of getting the gas out. Great, we can talk about that another time. But the commercialization bits, let's say you can work out the most effective way of doing this, and you can work out what your margins look like. You've got to sell this stuff. So what's the Northern Territory's market for gas like, and how much of this has got to be liquids and sold offshore? So what are you imagining that looking like?
Yeah, so we have a 2-phase commercialisation strategy. The first phase is focused on getting the pilot project up and running. We're quite fortunate that there's actually a pipeline running right through our tenement, only about 5 kilometres from our drilling sites. So while this is a quite remote area, we are connected to infrastructure. It is a small pipeline. It services a zinc mine called McArthur River, which is owned by Glencore, which is just 80 or 90 kilometres down the road from us. Our first phase commercialisation strategy is to fill that pipe up with gas. So that's about a 25 million cubic feet a day opportunity. For those who are not oil and gas people, that's about $60, $70 million a year of revenue. But that is very much a proof of concept and really balance sheet sustainability exercise that gets us into cash flow and production. The bigger prize is much, much bigger. We are talking about LNG export through Darwin and potentially Queensland. And to that end, we've signed an MOU with APA Group, Australia's largest pipeline operator. That's about a $12 billion company. They have an extensive network of pipes right across Australia. And working with them, they have developed what they call their Northern strategy, which is to follow existing pipeline routes, but with much larger pipes to Darwin, where there is capacity to add LNG export trains. And then also a new pipeline that would connect into Mount Isa in Queensland, from where they have a full network of pipes all the way through to Wallumbilla, which can service the LNG export terminals in Queensland, but also Brisbane, Sydney and Melbourne. These developments are coming at a really critical time for our gas market. The East Coast gas crisis, as they call it here, is almost daily news in our financial papers. There's a big shortage of gas on our East Coast, but also in the Northern Territory, the markets are getting quite tight due to a very limited number of sources of existing supply and the reliability issues that creates.
I mean, it's kind of interesting political situation, with obviously the Queensland market. You talk about Brisbane in there, the Northern Territories. These are not necessarily big towns. So in terms of your ability to sell into those territories, are they being restricted by other things such as infrastructure build? I know you talk about the pipeline group, but are there other infrastructure restraints or constraints in place that may hold you back?
So there is existing pipeline infrastructure that connects the Northern Territory to Australia's East Coast. That's through a pipeline called the Northern Gas Pipeline that connects Tennant Creek to Mount Isa. It's a relatively small pipe, a current capacity of around 100 million cubic feet a day. There are plans afoot to increase the capacity of that pipe. We do envisage that in the coming years, additional gas from the Beetaloo can go into Australia's East Coast without much further pipeline development. You can also increase the capacity of pipes through compression and looping and things like that. But ultimately, the prize here is so large that what will underwrite that bigger pipeline development will be LNG export.
Right. Okay. So I was actually wondering about the kind of storage component at some of these cities, like Brisbane, etc. But okay. So your kind of backstop is the fact that you can do the LNG exports into these ports. Okay. With regards to because I imagine that your shareholders are looking at this, or potential shareholders are looking at this project and going, man, we probably should just kind of sit back until that we get a much clearer view, or this company gets a much clearer view of what the equity requirements will be, what partnerships, joint ventures look like before we kind of dive in here. So, I mean, what would you say to those people about the path forward as far as the numbers?
Yeah, I mean, if I think about that in terms of what happened with coal seam methane companies in Queensland. So there were some incredible success stories in Queensland. One of them was Queensland Gas Company. One of our largest and most supportive shareholders, Dale Elphinstone, was a very substantial shareholder in that business and a director of the company for nearly a decade. And there were other companies that ultimately got taken over. What happened with that industry was that there was a relatively slow build-up of share price and value over time, but then essentially there was a very, very rapid M&A wave at the end where major international companies, BG Group, which is now part of Shell, Conoco and others, came in and bought out all of these companies because they essentially knew that at the end they had the fear of missing out, right? So they had to get in now or never. We're seeing a similar M&A wave occurring in the Perth Basin in Western Australia, where companies such as Warrego Energy are under offer. And, these companies, Warrego, for an example, was trading at around 12 cents a share. It looks like it's now going to get taken over for around 34 cents a share. So, when the tipping point happens, which in our view is around demonstration of commercial flow rates, you can see very large value appreciation quite quickly. And that's because the resource base on which we're sitting is so large that ultimately, it's our view that larger companies will feel that they need to own a piece of the basin.
Right. Okay. Re-rates are good in terms of the cost of money if you need to raise equity, but cash is also quite important. To generation of cash is quite important going forward. So you mentioned earlier the pilot plant. With that, will you be able to sell from the pilot plant before building presumably a larger demonstration plant? What price could you achieve? What sort of cash flow could you generate? Would it meaningfully contribute to the advancements of this project through the development phase?
Absolutely. So, the pilot project we're working on, as I mentioned, it's around 25 million cubic feet a day that we're targeting. That equates to, 50, 60, $70 million a year of cash flow at the asset level. We don't yet know exactly what that is likely to cost us. Part of the flow testing process is to work out how many wells you need to drill to fill the pipeline. But, under the regulations that the very supportive NT government have just put in place, we are now in a position that we can apply for production licenses. I can't really pinpoint for you right now what gas prices are likely to be, because obviously that's the subject of ongoing negotiations. But, I would point out, if you look at the macro in Australia, prices have been trading at extremely high levels last year. The government has actually had to intervene in the market to try and bring some control, similar to what's happening in Europe. They've put in a price cap of $12. The price is trading at $12. So, unsurprisingly, when you put a cap in place, it tends to be where the level where prices actually trade. It depends where we sell our gas. So if we were to sell it all the way into the East Coast, right now there's about $3-4 of transportation cost to get it all the way through to the East Coast. But there are a number of local markets for our gas. So local mines, there are gas-fired power stations in Darwin. And we have very, very keen potential customers who we're in close conversation with. So, these prices are quite strong prices from a historical context. At the beginning of my career, I remember when domestic gas in Australia sold for $2.50 or $3 a gigajoule. Those days are well and truly behind us forever, in my opinion. And we see, a strong market, but including willing purchasers of our gas.
But again, that's the kind of that we've seen a lot of that kind of political interference and price capping put on over here in Europe as well. But is there ever a distinction between domestic and commercial, like industrial gas usage?
Yeah. So essentially, the intervention in the gas market. Well, so the Australian government has intervened in the gas market to protect domestic consumers. Critically, there are no caps on export gas, for example. So that's quite important because the government wants to ensure that, Asian counterparties, for example, Japanese and Korean counterparties who are, critically rely on Australian gas for their energy security, continue to have that incentive to invest in Australia. So this is a temporary intervention in the market, really designed to protect Australian consumers who, as in Europe, are facing extraordinary rises in their electricity bills. At the end of the day, there's only really one real long-term sustainable solution to high prices, and that's more supply. And we believe that the Betaloo Basin is going to play a very important role in bringing down price pressure on Australia's east coast by bringing more gas into the market.
Okay, well, that's something to keep an eye on for sure. And just so I'm going to kind of finish off a little bit. How are you for money today? How much cash have you got, and how are you allocating that in 2023?
Yeah, so our quarterly report's coming out in a couple of days, so I won't give you the actual current numbers, but we recently announced some drilling results. We've currently got around $23 million cash in the bank. Our $15 million facility with Macquarie is completely undrawn, so there's capacity there. We also were fortunate to receive grant funding from the federal government, which was designed to encourage an acceleration of activity. There's about another $7 million to come under those grants for work that we have now completed. So we're in quite a sound position for a small company. For a $150 million company, to have around 25-30% of your total market cap in available liquidity is a pretty good place to be. Certainly a lot better than the $1 million cash we had in the bank when I joined the business 5 years ago. And what we're encouraged by is that the work that we will be doing this year, and with significant catalysts, doesn't involve lots and lots of capital expenditure. We've just completed a very heavy CapEx program, and this year it's all about production approvals, engineering, investment decision, gas sales agreement, and essentially we can do that well within our existing cash resources.
Okay, so no no planned further dilution or capital raises in 2023 is what you're saying?
Well, never say never, but right now we are certainly not planning a capital raise. I can assure you of that. Yes.
Okay, brilliant. Look, Alex, I appreciate you coming on and giving us kind of romp through where you're at and a little bit about the team and most importantly the plans going forward. And you kind of outlined some of the deliverables for you today, but you didn't mention the following. But is it a possibility, given the scale of what's ahead of you, would you be looking for more industry partners to come in, not just as like shareholders, but perhaps partners?
Absolutely. So, we have existing relationships with a number of the major US shale players. And if you look at our board, for example, Peter Cleary, one of our directors, extensive experience in marketing LNG to Japan, Korea, and China, who ultimately we see as being big customers of ours. We are not running a formal process right now, but I'll be in the US next week, attending the NAPE conference and visiting lots of the players there, updating them on what we're working on. But to us, bringing in a partner at some point is entirely logical because large companies bring two key things: significant technical expertise. In the case of the Asian counterparties, large demand for gas over a long period of time, and obviously they have a lower cost of capital as well. So that is certainly part of our plans going down the track.